Assalamualaikum and a good day to everyone. Today we're going to start a new chapter titled Preparing Cost Statement Using Absorption and Marginal Costing. So based on the title, you already know there will be two methods you'll be learning. Okay, so the objective of this chapter is able to explain briefly the concept, features, approach, as well as the advantage and disadvantage of absorption and marginal costing. We will also learn to prepare the cost statement using those two methods. So the content would be regarding those two methods which include the introduction, features and approach, as well as a way to prepare the cost statement using absorption and marginal costing. Okay, so let's begin. Introduction. So for a business, it is important to know the cost of its product. From there, you can set the setting price, you can make a decision-making process, you know the inventory value, also for recording the cost in the statement of profit or loss. So the common methods used in determining the product cost is either absorption or marginal costing. Okay, so marginal costing is also called variable costing. Marginal and variable costing are the same thing, but for your syllabus, it is called marginal costing. So from those two methods itself, the thing that differentiate them are the way it treats fixed manufacturing overhead. Okay, the way they treat the fixed costs are different. So if you have forgotten, fixed costs are a cost that is constant during the production period. Okay, based on the graph that I've shown here, as well as in your earlier chapter, it is a cost that stays constant during the production period. Okay, so moving on. Okay, so types of reporting. The reporting statement itself is used by two different groups. This I have explained in our earlier class as well. That you are used by internal or external group. So first is the external group, which is people that is outside of your business, outside of your organization. Okay. Second group is internal group, which is the people that works for the business, people that are inside the organization. Okay, so financial accounts are prepared for external users, while management accounts are prepared for internal users. Okay, so the difference between the difference in financial account and management account is the way that the data is analyzed. Okay, because the focus for each group are different, each users are different, so the data is analyzed depending on their demand and scope. Okay, moving on. Types of reporting, continuing with our previous slide. First with external. Okay, so external users, external reporting. Okay, so you know for external users, for example like bank, people that works outside of our business, what they want is that the data that is provided to them are assured it represents the business transaction. Okay, so external users requires assurance as well as a complete display of the business transaction, as well as it is accordance with legal and accepted accounting principle. So that is what external users want. The second is that internal users group, the internal users, which are the people that works inside the business, managers, employees. What they want is that from the data themselves, the statement, they want assured relevant information for control, for planning, and for better decision making. Okay, the data that is produced from the statement is for decision making so that the business itself can further improve for a better result. Okay, so the scope of each users are different. The internal wants to make the business better, so they want the data for decision making, while external users wants the information that has complete display or complete portray of the business activities, okay, which are assured and legally follow all the accounting principle. Okay, moving on. Okay, starting with the first methods, which is absorption costing methods, AC, absorption costing. It is used for external reporting purpose. So external users will look at these methods. All the manufacturing costs are absorbed into the production, which includes variable costs and fixed costs, which is the VCA plus FC. The fixed manufacturing costs are treated as production costs. So the fixed costs, the fixed manufacturing costs are treated as production costs. So this is important for you to remember, because why? Between those two methods, the difference is how they treat the fixed cost, the fixed manufacturing cost. Okay, so the operating statement does not distinguish between fixed and variable costs because they include both. Inventory value has both fixed and variable element. Okay, so recognize non-manufacturing as period cost. So any non-production, any non-manufacturing are recognized as period cost. Okay, it is deducted in the SOPL, which is statement of profit or loss. Okay. So absorption cost. It is used to determine the full production cost per unit. Okay, it is used to determine the production cost. So the formula is as below. It is prime cost plus production cost plus non-production cost. So prime cost, as we learned earlier, prime cost is DM direct material plus direct labor. Okay, the fixed production overhead are absorbed using the AOR, which we recently learned in our overhead chapter. So the production overhead are absorbed using the suitable basis, and the formula are as shown. Okay, so the principle that you have to remember for this method is that the fixed overhead are treated as production costs. Okay, so fixed overhead are absorbed into the opening and closing inventories in order to match the cost and revenue. So these are the principles that you have to remember for the methods. Okay, so due to the absorption using the OAR method, which is our predetermined absorption rate, there would be a difference in the actual and the budgeted overhead. Okay, so you know this because you just recently learned in chapter 4, there would be a difference. Okay, so the difference would be over or under absorbed overhead. Okay, when there's a difference which is over and under, you have to write off, which is deduct or increase depending on the situation, against the absorption costing profit for the period. Okay, you have to remember, because we are using the OAR, the predetermined rate, there would be a difference in the actual and the budgeted. Okay, so there will be three situations. The first would be, it will be over absorbed, second would be under absorbed, and the third would be equal. Okay, so this would be for your remembrance. Okay, I'm displaying this so that you would remember what is over, what is under. This is the same as in chapter 4. Over is when the budgeted is bigger than the actual. Under is when the budgeted is smaller than the actual, while equal, stated as the name, budgeted equals to actual. Okay, you have to remember this. Don't confuse. It is the same as chapter 4. Okay, so the treatment for overabsorb. Okay, we're starting with the treatment for if it is overabsorbed for the overhead. So when it is overabsorbed, the cost itself is overstated. The cost is charged higher. And the profit is understated. Okay, so when you overabsorb, which is the amount of the budgeted is bigger than what is actually happening, you're actually budgeting a higher cost. You're actually putting a higher cost in the statement. That's why the cost is overstated. So when your cost is higher or overstated, your profit would be lower. Okay, because cost affects profit. Okay, profit is due to the sales minus cost. Okay, so when your cost is higher, your profit would be low. So it is understated. So how do you treat when it is overabsorbed? The difference is overabsorbed. First is you deduct from the cost. So you deduct the difference of the budgeted and the actual, the overabsorbed amount. You deduct it from the cost. Second is you add to the profit. So it is two ways, not do it both. Okay, you either deduct from the cost or you add back to the profit. So that's how you treat for overabsorbed. For underabsorbed treatment, so the underabsorbed means that the cost itself is understated. The cost is lower, while the profit would be overstated. Okay, so when you budgeted a lower cost in your statement, and when the actual come out, it is underabsorbed, which means that you budgeted for a lower cost. Okay, it is lower than the actual that is happening. So the profit itself would be overstated. Okay, so the data would not portray what is actually happening. So when the data is not portraying what is actually happening, you have to treat it. You have to fix it. So how do you fix for underabsorbed? You add to the cost, or you deduct from the profit. Different with over, under the treatment would be contra. Okay, so because underabsorbed we charge the cost lower, so you have to add back to the cost. The difference is you have to add the differences of the actual and the budgeted. You have to add back to the cost. Second is you deduct from the profit. Okay, so that's how you treat the differences in absorption methods. Okay, this is the format for the absorption costing. So you have to look at both the methods. The statement itself is very different because the way they treat the fixed overhead. Okay, so this section would be different because absorption includes variable costing plus fixed cost. Okay, so this is for one period only. So this would be our format for absorption cost. And here you can see below here, this is how you treat for the differences. You will add if it's over, and you will minus if it's underabsorbed. Okay, so in accounting, brackets like this means you deduct. Okay, in accounting, bracket means deduction. Okay, hope you will try to remember the bracket. The bracket itself is very important in accounting because it's display the different in treatments. Okay, so example. So example for absorption costing. ABSORPTION company has provided the following information regarding its product alpha for period 1. There were no opening, so there are no opening inventory at the start of the period. It is also noted that the actual and the budgeted overhead are the same. Okay, so you can see that it is stated already that the actual and the budgeted are the same, which means this situation is the third situation which is equal. So there would be no differences. Show the statement of profit or loss using the absorption costing. Okay, so this would be our information for the example. So let's transfer it into a statement. Okay, so the solution would be, first you start with the sales. Okay, you start with the sales of the company. The sales would be per unit price multiple with the total unit sold. Okay, not the unit produced, but unit sold. So in this example, you can see that the production is higher than the sold units. So what you have to do for the sale is take this unit because we want the sales number. Okay, so that's how you gain the 8 million total for sale. After that, you deduct the total production of cost of goods sold. Okay, so this is the title only. There are no amount. It is only a title which you have to write. Okay, to know what are you deducting. In the title, in this section, we have an opening balance. So as stated in the example, there are no opening balance. So we put this or 0. So you plus the total production cost. Okay. So for absorption, you take VC plus FC, variable and fixed cost for the production, and you times with the product that you've made, the production unit. Okay. So you can see that for the VC is, you have direct material, direct labor, and variable overhead. Okay, you include everything. This would be your VC. So this is your VC per unit. So you have to time with the unit produced. Okay. Okay, so after you identify the VC, now you want to find the FC, the 1.5. So where do you get the 1.5? There's no 1.5 in the example. In the table itself have shown no 1.5 fixed cost per unit. It only displays a total. Okay, so this is the total of the production overhead for the fixed cost. What you have to do to get the 1.5 is you take the 375 and you divide with the 250 units of production and you will gain 1.5. Okay, so if you don't want to write it like this, you can also write it as 22, which is our VC, times 2.5, 1 bracket, plus the fixed cost itself, which is already a total. 375. It would still showcase this amount. Okay, we want to know that the total production cost for the absorption is VC plus FC. That is what we're trying to achieve. Okay, after you've gained your total production cost, you have to deduct the closing stock. So what is a closing stock? Closing stock is the stock that is unsold for the period. Okay, it is not sold during the period. 50,000. Okay, so you can see that the product is produced to 250,000 and the sold are 200,000 only. So the difference will be between the two is 50,000. Okay, so that is the closing stock unit, the 50,000. Where do you get 23.5? Is the VC plus FC amount. Okay, it is this amount. So you have to deduct the closing stock. You deduct and you gain this amount. After that, how to get the gross profit margin? It is the sale minus the total production of cost of goods sold, and you gain this amount displayed. After you've done the above section, you've settled with the production section. So you have to minus with the non-production section, which is the selling and admin cost. So you have to include the variable and fixed, which is also displayed in the table before. So the fixed is calculated for you already. So you just put in the amount. While for the variable, they gave you per unit price only. So you have to calculate. You have to take the 3 ringgit multiple with the 200,000 unit. So you gain this amount displayed. And the total of those two would be this. And after that, you take the 3 million, deduct with the 750,000. The net profit for the period would be as shown. Okay. So using the absorption costing, the profit would be 2,550,000. Okay, so this is absorption costing. Okay, so let's move on to our next methods. The second method, which is marginal or variable costing, it is used for internal reporting purpose. Only variable manufacturing costs are treated as production costs. So you can see that that's the difference with our previous methods. It only takes the VC cost as production costs. The fixed manufacturing costs are not absorbed into the cost of production. Hence, they are treated as period costs and written off in the SOPL. Okay, so it is not absorbed in the production cost. Inventory are valued at variable cost only, and non-manufacturing not included in the production cost. Okay, non-manufacturing is not included at all in the production cost. Okay, so variable cost, if you have forgotten, it is the cost that change with the increase or decrease of the unit product produced. Okay, based on the graph here, as well as in our earlier chapter, it is the cost that change due to the change in production unit. Okay, so it moves the same as the unit produced, the cost itself. Okay, so next. So the thing that you have to remember for marginal costing is that contribution is important. So contribution is sales deduct variable cost. After you gain that contribution, you have to deduct it with a fixed cost, and after that you would attain the profit. Okay, so different with the previous methods. For this method, we have contribution. Okay, so the principle that you have to know for this costing is that all fixed costs are assumed to remain fixed at any volume of sale or production. That is why it is considered as period cost. So this method, they assume that the fixed costs are the same. That's why they exclude it. Okay. Extra cost incurred in producing one extra unit is the variable cost per unit. So any extra cost that incurred during the production cost, it is also categorized as variable cost per unit. So no additional fixed cost is incurred during output increase. So because they assume the fixed cost is constant. So any changes in the production unit is also recognized as variable cost only. Okay, the sales revenue will increase by the sale value of the item sold. Okay, so the sales increase as the unit produced increase. Okay, the contribution will increase or decrease as sales revenue increase or decrease, provided that the selling price per unit and the variable cost per unit remain constant. Okay, so when the selling price and the variable price per unit remains constant, remains the same, the contribution will increase if the sales revenue increase. And if the contribution decrease, which means the sales revenue decrease. It is a linear relationship, a direct relationship. When revenue goes up, contribution goes up as well. Okay, so profit will increase as contribution increase, and profit will decrease if contribution decrease. The same as before, it is a linear relationship. Both goes up, it's either up or down, the same way for profit and contribution, as well as contribution and sales revenue. Okay, so this is the principle that you have to remember for the marginal costing. So this is the format for the marginal costing. As I stated before, there are differences between the two techniques because the way, they treat the fixed costs are different. You can see that this one only have the variable cost. Okay, so it is variable cost until you get a net contribution. Okay, after that, you will deduct the fixed cost. Okay, so because the difference on the fixed asset treatment is different, for marginal, there would be no over or under absorption. We don't apply the OAR rate here. Okay, so after you deduct the fixed costs, you will directly achieve the net profit. There would be no under or over. Okay, so it's a direct calculation. You don't have to think about the rate. Just you have to know that the difference the upper side is for variable, while the downside is for the fixed cost. Okay, let's look at the example. The example is the same as the one before that I've explained for absorption. The amount is the same, the story is the same. There are no opening still in this example, and the budgeted and the actual are the same. Okay, which we will not apply in this method. There are no over or under absorption in this method. So using the marginal costing, so you can see that the sale amount for both methods are the same because the price unit and the unit sold are the same. So the sales revenue are the same. The difference is here, how they calculate for the production cost. They will only take the variable price only. Okay, they will only take this one. Okay, they don't take the 375,000. They only take the variable cost per unit only, and directly for the production they directly multiply with the unit produced. Okay, so that you gain this amount. For the closing stock still 50,000 unit, which is the balance from the unit that is not sold, they times with the variable per unit only. So you've gained this, you deduct the closing stock, and the amount is 4,400,000, and the gross contribution is 3,600,000. So it is gross because we are not yet deducting with the variable selling and admin overhead. Okay, so after you deduct the selling and admin, which is the non-production sector in the cost, after that you will gain the net margin, net contribution margin. Okay, so this is focused on VC only. The amount 3 million. So after that, after you gain the contribution, you will deduct the fixed cost and gain the net profit. Okay, both this amount are in the table. You don't have to calculate. You just take it and put in the format and calculate for your net profit. Okay. So the difference is how they treat the production and how they treat the fixed cost. So if you go through your slide later on, you can see that actually absorption cost has a higher profit compared to marginal. Okay, so compare and look. So this would be the comparison between the two methods, a summarization. Okay, you can look what is the difference between the two, which I've explained detail above. So moving on. Okay, so now we are comparing between the two methods and its impact on the profit. Okay, so we're comparing AC with MC and how it impacts the profit. So when the production units equals to the sale unit, the profit of the two methods would be the same. Okay, it would be the same. Okay, so this is when the unit and the production is equal to sales, the unit, okay? But when the production exceeds sale, when the product is bigger than sales, the unit, AC will be higher than MC, okay? So AC would be higher than MC when the production is bigger than sale. Profit in terms of profit. So the profit of AC would be bigger than MC. So this is the same as the case before, the example that I've shown you. When the production is bigger than sale, AC would produce higher profit. Okay, the last situation would be the sales is bigger than production. So when this happens, the MC is bigger than AC, the production, the profit. The profit of MC would be bigger than AC. Okay, so this is the situation between the two methods. So the example here is that Margo company produced a baby product called QT, which has a variable production cost of 5 ringgit. So this is our VC. And a selling price of 10 ringgit. So this is our selling price. There are no opening inventory in period 1. So in period 1 only, there are no opening. And the budgeted actual fixed production overhead amounted to RM50 at normal activity of 20,000 units for each period. Okay, so in this example, there are budgeted and actual fixed production overhead. So you have to calculate for the OAR here to find the over and under. The actual fixed admin selling distribution amounting to 12,000 per period. So all period have the same non-manufacturing cost. The following information relates to QT product for 4 periods. So we have 4 periods and all the periods are different in terms of production and sales. So you are required to prepare MC and AC system for the 4 period. Okay, so from this example, you can see the difference between the profit of the two methods. Okay, so in terms that you can see that which is higher, which is lower between the two methods. So let's look. Okay, starting with marginal. Okay, the calculation of the amount itself is as I've shown in the example below. So unit sales is the unit that you sell for the period times the unit selling price is Rm10 based on the paragraph above. So you gain this amount. And if you look between the two methods below, this is marginal, now it's absorption. The amount itself is the same. So the sales are the same between the two methods because they use the same amount and same unit sales. So the difference starts here, the production. So marginal only focus on VC. So you have to only look at the VC cost. Cool. Okay, so the statement above state that the opening inventory for period 1 is 0. There are no opening. So there are no opening here. So you put a dash or put 0. And after that, the variable production cost is 100 based on the paragraph. You can look. After that, there are no closing inventory because period 1, they sold everything. The thing that they produce, they sold all. They sold everything. See, it is equal. So there would be no closing stock, and you just directly drag the total here. And you minus the 200 with the 100, and you gain a margin of 100,000. Okay, so the fixed cost, production overhead and admin, as stated above, as stated in the paragraph, is as shown. And you just deduct 100 with the total of the fixed cost, and you will gain 38,000. Okay, so that's the profit for period 1. Now we're going into period 2. So the situation with period 2 is that the production is higher than sale. Okay, so you can see that the sales revenue is lower because the sales amount is lower. Because we multiply the units of sold for sale. Okay, so in the variable section, period 2 also has no opening inventory. So it is 0. Why? Because there is no stock at the end for period 1. So we cannot transfer it into period 2. So the variable cost is the same, and we would have an ending inventory, a closing inventory, because there are balance in our production unit. We only sold a few, and the few will be put into closing inventory. And after that, you will gain 75 after deducting 100 with the closing inventory. And then you would take the sales, deduct with the 75, you will gain contribution. And the contribution would deduct with the fixed cost, gaining profit about RM 13,000. So that's the end for period 2. For period 3, you can see that the sales is higher than production. So the sales is higher. The sales revenue is depending on the unit. And this is a mistake. Because there is an opening stock, because in period 2 there is a balance. So there would be 25 here. Sorry, a plus 25. There is a 25 here plus for our opening. We carry on from the closing stock to the new period. So the variable production is the same. And the ending is the balance in the current period that is not sold. Okay, so when it is not sold, it is a closing stock. So 25 plus 100 minus 10,000 is actually 90. Okay, and after deducting 180,000 with 90, you also gain a 90 here. Okay, so the 19 that you gain from the contribution, you deduct with the fixed cost, gaining the result of 28,000. Okay, after that you go into period 4, carrying on with the closing end of 10,000 in the opening, and the variable production cost as well as the unsold units. Okay, so the unsold unit, you will gain a 100, 200 deduct 100, you will gain another 100, and the ending is 38,000. So that's the end for marginal costing. Looking into the same example with absorption costing. Okay, so absorption costing, the first period, the situation is sales equals to production. Okay, so there would be no opening, just like marginal. The total production cost is VC plus FC, and multiple with the unit produced, you gain the 150 amount. Because we sold everything, there is no ending or closing inventory. So you just drag the 150 into the total. 200 minus 150, you gain a 50,000. So the admin and selling contribution would be 12,000. And if there is any over or under absorb, because this is an absorption method, you would put it here. But because we sold everything, there are no over or under. It is a situation with equal overhead budgeted and actual. So there is no amount. So you directly deduct 50 with 12. And you gain a 38 as a result for the profit. Okay, sorry for that, my throat is getting dry. So moving on to period 2. Okay, so in period 2 is the situation was that the production is bigger than sales. So the sales revenue is the same as the previous methods, with no opening as well, because period 1 we sold everything. The amount of the total production cost is the same as period 1, and there is an ending inventory because there is a balance in our production unit. We did not sold everything. Okay, so we have the total from that here, deducting 150 with the amount, the total we gain from the production, and we gain a profit margin 37.5 thousand. Deducting with the non-manufacturing cost, you will gain a net profit of 25.5 thousand. Okay. So this still has no over or under absorb. So in period 3, the situation is that sales is bigger than production. Okay, so the sales revenue is as displayed. In the production cost calculation, we can see that the opening balance is gained from period 2. And the total production cost is due to the change in production unit. Okay, so the production unit for period 3 is different from period 1 and 2. So the calculation would be different. After you add on with the previous period 2 and period 3 production unit, we will have a balance about 2,000. Okay, so there is a balance Because of the balance of the unsold balance, there is a closing unit. Okay, so with the closing unit, you deduct and gain the amount 135,000. With the sales revenue, deduct with the cost production, you will gain a 45 for the profit margin, the gross profit margin. After that, you deduct with the admin and selling contribution, which is 12,000. And for period three, you have an under absorbed overhead, which is a 12.5 thousand, and which gains a net profit of 20.5 thousand. Okay, so the detailed calculation for the under absorb is in the note section of this slide. Please review it. For period 4, you can see that the situation is that the sales is lower than production, and this is the amount for sales revenue. The opening inventory is gained from the previous period, and this is the current production cost, and there is a balance of 30,000. Okay, with the total and calculated, you will gain a 150. Minusing 200 with 150, gaining a 50,000 balance. Deduct with the admin, sales, and contribution cost, as well as an over-absorbed overhead. You will gain a 43,000. So when you compare the two, you can see what I have stated in our earlier slide when comparing the two. There is a situation where AC is higher than MC. There is a situation where MC is higher than AC. Okay, you look and compare between the two and understand why they are different. Okay, so the difference in profit between the two is these are the reasons. You can see that it is explained by the movement of fixed production because they are treated differently. Both the method treat the fixed cost different. Because of that, they affect the profit. Okay. Okay, so the argument for absorption cost is that in favor, which is they support this method, is that fixed cost is a part of the total cost production. Okay, so they agree that fixed cost is also in the production cost. Second reason is that it matches with the accrual concept that follows. So accrual concept is that cost is matched with revenue. So fixed cost itself is a cost, so it has to be included because it will match with the revenue. The third is consistent with the requirement of IAS 2, International Accounting Standard number 2. The third is possible to ascertain whether the product is profitable or not. So when you include all the costs, you will see whether or not the product is gaining profit or giving you loss. Lastly, reporting of high losses during off-season and high profit during peak season can be avoided. So it is due to, you can see the actual result and actually prevent fluctuation between the off and on season. Okay, so for the argument against the methods, the absorption methods, this is people that against using this method is that apportionment and absorption of overhead is arbitrary. Okay, so what does it mean by the statement? We know that in absorption costing, we use OAR, which is a predetermined rate for overhead. Okay, so because of the predetermined overhead, we use a self-determined basis. So because of that, it might be subjective and may not be appropriate. Second argument is that may encourage overproduction as income can increase by increasing inventory level. So from the statement, you can see that when the inventory increase, the income also increase. So this might encourage overproduction. So the third and last argument is that when the inventory are unsold, the closing stock with the absorbed fixed overhead from previous period may have to be written off in later accounting, resulting in the current reporting income to be overstated. Okay, because they absorb the predetermined, they might have to be written off later on. So the income will be overstated. Okay, next argument for marginal costing. So supporting this system is that this simple system with no arbitrary apportionment and absorption of fixed overhead. Okay, so because they don't use the predetermined overhead, it is a simple and direct system. The fixed costs are charged against the revenue of the period which they are incurred. Okay, so the fixed cost is still charged in the statement, just in the different position. The third is appropriate to charge only the variable costs as they are directly contribute to the production unit. Okay, so based on the supporting argument, they said that variable cost is the only cost that contribute to the production unit, thus it is suitable to only take variable cost. So the fourth is no need for managers to overproduce. So there won't be any overproduction using these methods. And lastly, more relevant information for short-term decision making. Okay, for any short-term decision making, it is suitable since marginal costing is used for internal users. People that are against the system is that the information provided may be inadequate for product cost and product profitability. Okay, so it's not suitable for any production total cost because we only took variable cost as well as the product profitability. The second is the direct labor cost may not be variable if employees are paid fixed wage or salary. Okay, so the second one, we have a direct and indirect labor cost, right? But direct labor cost might be a fixed cost. So in this system, we exclude the fixed cost. Thus, the labor cost might be excluded from the production even though they are a direct labor. So they are saying that it might not portray a correct production cost. Lastly, it's inappropriate to treat all fixed production overhead costs as fixed period costs. Okay, so it is not suitable to categorize all fixed costs as period costs because period cost is indirect costs. Okay, some fixed costs are direct costs which contribute to the production of products. Okay, so those are the against and in favor for marginal costing. So the key points you have to remember is that in AC, absorption costing, is that you have to check the under and over absorb. For MC, there are no under or over, but the fixed overhead are treated differently. So the difference in profit is due to the fixed overhead treatment. With the closing inventory, profit is higher than MC's profit. With the opening inventory, MC's profit is higher than AC. Okay. So the slide is referring to the book Management Accounting 3rd Oxford University Press Chapter 9 if anyone would like to refer. So that is all for this chapter. Hope you understand. Do ask any question if you don't understand. Thank you.